Welcome to the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Welcome back to the Teaching Tax Flow podcast, everybody. Today's episode number 52. Perfect time of year to do this, but we're going to take a look at the tax bracket updates for 2023. So what you can expect for this year currently that we are in, again, 2023, tax year 2023. So before we do that, as always, let's take a quick moment and thank our sponsor.
Are you leaving money on the table? Are you an accredited investor seeking new and exciting investment opportunities? Look no further than Integrated Investment Group, your trusted partner in financial success. At IIG, the focus is on delivering exclusive investment options tailored to your unique needs and goals. Contact them today and let their expert team guide you toward your financial aspirations. Wondering if you qualify as an accredited investor? Visit teachingtaxflow.com/IIG to find out and take the first step towards a brighter financial future. Integrated Investment Group, your path to financial success begins here. Securities offered through Cabin Securities. Member FINRA SIPC.
Welcome back to the podcast as always. I'm John Trapolsky here from the TTF team, joined as always by my better looking brother from another mother, Chris Pacuro. What's happening, man? How are you?
I am well. How are you doing?
Oh, I'm doing fantastic, man. We're about to talk about tax year 23 updates, so I hear. Is that correct?
Well, I'm sure everyone's been waiting with bated breath for the IRS's Revenue Procedure 2022-38. Sounds exciting, but actually it really helps on the tax planning and strategy side of things. The IRS came out, announced its tax brackets for the 2023 year. So this will be for tax returns being prepared in 2024, but for the 2023 year for individual tax returns. They also have some other inflation-related items that we're going to chat about at the end of this podcast. But I want everyone to remember that although we're going to be talking about tax brackets, which are very, very important, it's really important for everyone to understand their MTR, their marginal tax rate. The marginal tax rates takes into account other factors other than a tax bracket. It takes into account phase outs of certain credits and deductions. That being said, the heart of your MTR is the tax bracket. So let's talk about what the IRS did for the 2023 tax brackets.
Alrighty. And yeah, these are, Chris, these changes that are made, obviously released direct from the IRS. Is this something that they change often, or is this really big news in a sense that, there's been a change? Here's what the change is. I mean, how often do they do this is actually my question.
These are adjusted each year for inflation, and a lot of times they're very, very minimal adjustments on these tax brackets. But we saw, based on the economy and some of the inflationary issues that are occurring, I think the adjustments upward were more generous than expected. And when a tax bracket adjusts up, usually when you hear tax and up, you're thinking that's a bad thing. But what that means is that you're allowed to keep more income in a lower tax bracket. As we know, we have a progressive federal tax here in this country. So the larger your taxable income is, the larger the federal tax is and the rate of that tax. Now, we do get this a lot in just John, you and I out and about at conferences talking to taxpayers. We've had this question come up quite a few times in our Defeating Taxes private Facebook group. And I want to be clear that if your tax bracket, really that tax bracket, the importance of that is for every additional dollar you earn, what is that dollar taxed at? So John, let's say you're in a 10% tax bracket and your income goes up and you go into the 20% tax bracket. Now, there's no such thing as a 20% tax bracket, but let's just play along. A lot of times people think that, oh no, that's terrible. All of my income is now going to be taxed at 20%. That's not true. Only the amount of income that exceeds that 10% bracket gets taxed at 20%. It doesn't retroactively go back and tax all your income at that higher bracket.
Excellent. I'm glad you explained that too, because this is something that even, many years back, I used to always think about, right? It's like, if I go over by $1, then, I'm kind of, I'm in the hole then for everything leading up to that $1, which is not the case at all. As you mentioned, it's, it's almost like a ladder approach. So it's like, yes, you're in this bracket here, which then this bracket here is this amount, and then, all the way up the ladder, per se.
Well, this time of year, we've just went through the tax extension filings, and we're looking at fourth quarter of 23. And we're inevitably, especially in our private CPA practice, running into taxpayers that have a significant amount of income, and they're concerned about taxes, and it's a very valid concern. That being said, I've yet to see 100% marginal tax rate, so you're better off having taxable income than not having taxable income. It's just a matter of what you do with that taxable income really dictates the amount of tax you're going to pay on that.
Excellent. So walk us through these changes a little bit. If somebody doesn't have this in front of them, what are these updated brackets for tax year 23? What are we looking down the barrel at?
Let's do some really easy math, because you might be out for a jog, a run, you might be driving. So let's think about back of the napkin math. Let's say you have income. Let's say you have a W-2 for $40,000, and let's say the standard deduction is you're married, your spouse doesn't have any income, and the standard deduction is $20,000. So $40,000 of income, $20,000 standard deduction. You would then be taxed on $20,000. 40 minus 20 is 20. So there have been adjustments not only to the taxable income brackets, but also the standard deduction. The standard deduction is the amount that you can earn before you pay a penny of federal income tax. Now, we're not talking about self-employment tax, and there's another episode about itemized deductions versus standard deductions, but we're going to assume, looking at the standard deduction, that's the amount of income you can earn without paying any federal income tax. So for someone that's married filing jointly, that number went up by $1,800 from 2022 to the 2023 year, and it's up to $27,700. So a married couple can make, filing joint couple, the first $27,700, regardless if you have a mortgage, make any type of charitable contributions, pay any type of taxes, you can earn $27,700 and pay no federal tax. That's pretty generous. And that went up by $800. For single taxpayers or married individuals filing separately, that amount went up $900, so half of the $1,800, to $13,850. So and that's now your new standard deduction. For head of household, the standard deduction which is a special filing status when you are single, yet you have dependents, or qualifying person in your household to make you head of household. That standard deduction went up $1,400, kind of cutting it in the middle, to $20,800. So the bottom line is, let's take a college student, right? Let's say a college student works a W-2 job. They earn $10,000. They have no federal income tax to pay. Now, they've paid into Social Security and Medicare, and their employer may have withheld federal income tax. That federal income tax would be returned to them when they prepare their tax returns. So it's really important to understand, for anyone in the situation that is in an earning level below the standard deduction, you would be in our teaching tax flow system a very high green diagnosis, meaning you could be putting money into a Roth IRA or doing things that are going to defer tax or reduce your tax. Does not make sense, because you're not paying any tax in the first place. Federal income tax. Again, we're focusing on the federal income tax, not any type of self-employment tax.
Excellent. And really quick question too. I know we speak about different tax strategies as it relates to somebody's marginal tax rate or, their bracket, but really on how someone could take advantage of certain strategies when it comes, to quote unquote tax time, and really raising that level, or I should say that dollar amount for an individual to not yet have to pay federal income tax. That really extends the opportunity even further for, say, somebody wanted to hire their child, right, to operate their business, regardless of what they say they do in the business. Totally irrelevant at this point, but it raises that bar even a little bit higher. So that obviously extends to that tax strategy as well, correct?
Absolutely. So the strategy of, let's say you do hire your child and they're doing legitimate work for the business, this makes it more lucrative. So I'll give you an example. Let's say your child is single. They're helping you out with your business. You pay them, $13,500 on a W-2. They would pay no federal income tax. And in fact, if they didn't have any federal tax withholding, they wouldn't even have to file a tax return. They could, though, put money into a Roth IRA because they have eligible wages and let that money grow tax-free.
Excellent. So yeah, it all kind of ties together some way or another. But as far as for the other,
that standard deduction is a hurdle. Until you get over that hurdle, you're paying no federal income tax anyway. Once you get over that hurdle, that's where the tax brackets kick in. The highest tax bracket, the top tax rate, is still 37%, which is very low historically. And that's for taxpayers that are in the almost, for married joint, about $700,000 of taxable income. The single taxpayers about $578,000 of taxable income. Now, again, when you get into those ranges, your marginal tax rate and your tax bracket are different because there are other taxes and phase outs that come in. So a great way to think about the difference between marginal tax rate and tax bracket, the difference is larger the higher amount of income you have or the very low amount of income that you have. In the middle, there's not so much of a difference. And why would I say that? Well, if you're in the lower income situation, and you're qualifying for an earned income credit or a retirement savers credit or deducting student loan interest, those things phase out once you get to kind of that middle income area. So yeah.
So a college kid that's a part-time worker, MTR is not as important to them to fully understand. On the other side of the fence, somebody that's over 100K plus 200K, 300, 400K a year, obviously MTR almost supersedes tax bracket more importance.
Correct. I would say that the MTR, the difference between your marginal tax rate and your tax bracket is significant when your income's, let's say, really small or really large. We'll just put it that way. So we have those tools already set up for people to use to figure out their marginal tax rate.
Excellent. So if somebody hasn't looked these up, they are on the IRS website. And actually, we'll put the link in the show notes on this one, too, if you wanted to read a little bit more about it. Chris, I know you have already read this about 13, 14 times in its entirety. So we know you've read it plenty of times. What other pieces of this change, are either in effect now or going to be in effect as far as for everything done here?
All right, so for single, let's talk about something. The lowest tax bracket or tax rate's 10%. So for single people, that 10% tax rate extends up to the first $11,000 of income. For married joint, $22,000. So John, in theory, a married filing joint couple has a standard deduction of $27,500, and stays in the 10% tax bracket for the first $22,000 worth of income. So 27.7 plus 22 is about 47. Let's just say someone that's married jointly, their first $48,000 of taxable income, rather, obviously that'd be about $22,000 of taxable income, would cost them only $2,200 worth of tax because it'd be in that 10% bracket. After the 10% bracket, the brackets go from 12, 22, 24, 32, 35. Most people kind of live in that, 12% bracket to 22%. If we're talking about married couples, the first, up to 22% of $22,000 of taxable income, the 10%, and then it goes into the 12%. The 12% bracket from $22,000 of taxable income for a married couple up to about $90,000. And then at $90,000, it goes from 12 to 22. So here's the big takeaway. For someone that's a married couple, understand that your marginal tax rate will pretty much double once you go over about $90,000 worth of taxable income. And that is about $127,000 worth of total income. So for someone that, let's say they make a nice wage of $110,000, let's say their spouse is a homemaker, in essence, they never get over that 12% tax bracket, which is very generous. It's half of that for someone that's single. So that's just how the brackets work. So for someone that's a single taxpayer or married filing separately, you jump into that 22% tax bracket, which is where a lot of people live, at $44,000 of taxable income, or approximately $57,000 worth of total income when you look at the standard deduction. So, anyone in the 10 or 12% bracket, we really treat them as a gold diagnosis. We're not too concerned about tax. We're looking for more tax-free income and growth, especially for retirement planning. So once you get into that 22, 24% bracket or higher, and we're talking federal rates, not even state rates, then you start getting into that red diagnosis where you're going up into the, you're paying your involuntary business partners, we like to say, the IRS and any state or city that you live in, a significant amount of your income. But
which actually segues into a question I was going to ask too, is, based off of your experience, what, we won't even say at what tax bracket, but usually at about what income level do you really start to stress or drive home with clients in y'all's private practice really the importance of tax planning? Is it something that you really try to get them aware of very, very early on when they really, we shouldn't say can't take advantage of things, but they obviously can't take advantage of most of the strategies and opportunities that are out there? But at what point do you really start to tell them, like, if you don't do anything, you're almost a village idiot at that point? So,
well, I believe at all income levels, you should be tax planning. It just comes down to diagnosing and prescribing, right? So diagnose your tax situation, prescribe different tax opportunities. So let me give you an example, because the lie that we're told is that you have to have a lot of income or a lot of assets to do tax planning. I would argue that the people that don't have a lot of income or assets, tax planning is much more important because their margin for error is very low. So let's think about someone that is in, let's say you have a single person. Let's say she's a teacher. She just got a teaching job and she's going to start off at a base salary of $50,000. I'm just making numbers up. We know teachers are very underpaid, but let's just say that's the starting wage. She's single, no children. Her first $14,000 of income would be tax-free. It's because it's under the standard deduction. The next $11,000 worth of income would be at 10%. The remaining amount would still only be at 12%. Why is it important for her to? It's important for her to start saving for retirement, but a lot of times she might start putting money into her, and typically teachers will have a 403B or 457 plan, but a lot of times they put money into the retirement plan tax deferred. And now this money grows after the next 40, 50 years, and she's going to have to pay tax on it when she takes it out when she's retired at a very high, and probably a higher tax rate, and she's going to have to pay tax on all of that growth. Well, I would argue that she should deeply consider putting money into a Roth component of her retirement account or funding a Roth IRA, because the tax benefit is so small right now. It's more, think about that, $5,000 into that Roth. If the money doubles, it should double, let's say, it should double 5 times, okay? Before she retires. So $5,000, the tax benefit for her putting money into that $5,000 into a pre-tax account is only $720, let's say, $600 to $700. But if she lets it grow tax-free, 5 doubles to, oh boy, I might have signed myself up for a bad calculation on a live podcast, right?
Hey, it's okay.
5 is going to double, becomes 10, becomes 20, becomes 40, becomes 80, becomes $160,000. So that decision today gives her $160,000 of tax-free money when she retires. So for her,
it's amazing how it compounds.
What's that?
It's absolutely amazing how it compounds like that, isn't it?
So just something like that. Another factor, if looking at health insurance, she should put money pre-tax away for her health insurance. She should contribute to a health savings account. Even if she's healthy, put the money away tax deferred now, because that money will grow tax-free. And as long as it's used for health, qualified health expenses, medical expenses, it's tax-free. So she might be single and healthy now, but what happens 15 years down the road if she has a family and she has someone in the household that's ill and needs some money for medical expenses? So planting those seeds early, it's just as important for someone, no matter what their age, at a beginning income level than just people that are in a high marginal tax bracket. So
excellent.
And that's one of the reasons we started this podcast, and started teaching tax flow, to help people out.
So we appreciate all the 10-year-olds that listen to this podcast. You're doing a great job. So
we're trying.
Keep taking the tips, right?
So we're gonna touch on a couple other things IRS did in this revenue procedure with their inflation adjustments for 2023. We talk a little bit about estate planning. We are in the golden era of estate planning, meaning the estate tax exemption is at an all-time high. What that means is that if you pass away, how much in assets can you transfer to your beneficiaries without them paying any tax, or your estate paying any tax? Now, if the beneficiary is your spouse, that's another story. But the point is, the estate tax exemption went up to almost $13 million, $12,920,000, went up $860,000 from 2022 to 2023. For those, we had an amazing guest on our Mr. R Show podcast, which is designed for tax preparers who specialize in foreign income and foreign taxpayers here in the U.S. or expats doing business overseas. But the foreign earned income exclusion went up to $120,000. So if you're a U.S. resident, you're working overseas, you get an exemption from your foreign earned income here in the States for potentially up to $120,000. So that's generous. The gift tax exclusion went from $16,000 to $17,000. What that means is that I can give up to $17,000 worth of gifts to as many people as I want without ever paying any tax, without them paying any other tax, and without even reporting it. Now, obviously, we have people in the community that are giving out more than that. And there are some advanced strategies for avoiding tax when you're transferring assets or gifting, but that's important. So those are some of the key items. The only other one I want to mention is the earned income credit. The earned income tax credit is for working families that are in a lower marginal tax rate. And that credit, which is a refundable credit, went up over $500. So the max credit, and it's need-based, is $6,935. Now it's $7,430.
Awesome. And again, these numbers, or these increases in a good way, good increases, not bad ones, those are for tax year 23. So this does not affect anything prior to that. Strictly 23 and beyond, until there's obviously another change, correct?
You are 100% correct.
Hey, I'll take it. And on that note, I always got to quit on a high note. If anybody, again, as mentioned a little bit earlier, really wants to read into this a little bit more, we'll put the direct link on the IRS's website. I know we have that. We'll put it in the show notes here, so you can click on that, follow through. It outlines pretty much everything we talked about for the most part. At least those brackets are very clearly defined on what is what in there, as well as some other items as well. So hopefully everybody enjoyed this. Hopefully you took it as good news. There's no bad news here at all, at least in my eyes. Chris, I think you'd probably agree with that as well. So please check it out. Feel free to read that article. This will be something that obviously we'll be talking about for probably the next year. These numbers will be referenced over and over again. So Until next time, we'll see everybody next week.
Thanks as always for joining us on this episode where me and Chris dove into the wonderful, but yet sometimes misunderstood topic of IRS federal tax brackets. So, that being said, any further questions, as always, feel free to reach out to our team directly. Send us an email at hello@teachingtaxflow.com. Jump onto that Defeating Taxes private Facebook group, as always. But even more importantly now, we have launched, this is coming up on October 20th, 2023 at 1 p.m. Eastern. We are doing a free mastermind on tax planning. So, if you're familiar with tax planning, obviously you know the value in what we are going to cover on this free live webinar. We're doing it on Zoom, by the way. No need to hop on an airplane. But, as I was mentioning, if you know the value of it, obviously it's a no-brainer. Hop on it, you'll learn a couple things. But also, if tax planning is really a new concept to you, you're not sure what it is, you think, well, maybe it's only reserved for, the ultra-wealthy or somebody such as, not myself. It's for somebody else. It's not a fit for me. Please jump on that. Even if you jump on for half of it, if it's not something that interests you, not something that you feel is right for you, I can almost guarantee that your mind will be changed. Tax planning is something that every U.S. taxpayer, basically every single person, can take advantage of in one way or another. So, if you look in the show notes, down below, off to the left, off to the right, wherever you're listening to this, I'm going to drop the link in there. This is a direct Zoom invite registration link. Really 3-4 questions that are on there. Fill it out. Join us for that tax planning masterclass. Again, free. We're doing this on Zoom. Chris Picuro, also who you heard on the show, is going to be hosting this for us. He is going to dive into some fantastic tips, tricks, strategies behind this. You don't want to miss this one. So, we will see everybody on that masterclass and on this podcast next week.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.